Today's show is brought to you by Court Kamen, my guy over at Old Republic Title. They do commercial title services, everything A to Z, from owners and encumbrances reports to title commitments to closings. I highly recommend their services, and you'd be doing yourself a solid to give Court a call or text at 612-336-7215. That's 612-336-7215. I highly recommend these guys. This is not an offer or solicitation for any financial or real estate services. This is solely the opinions of Mike Sowers and Dan Ruehl, and not the opinions of SR Realty Trust, Schaefer Richardson, or Commercial Investors Group. So you have your property under contract to sell it. Now what are you going to do with your money? Dan Ruehl is on the show today, and we're going to cover all your options. And they go well beyond a 1031 exchange. Dan has really opened my eyes to the world of possibilities when it comes to exchanging your money into different opportunities. Welcome to the show, Dan. There are two kinds of people in the world. Those that worry sharing their ideas will hinder their success, and those who are driven by the success of others. The first kind view everyone as a competitor. They guard their playbook tight to their chest, rarely collaborate outside their inner circle, and are reluctant to show their cards. Then there are the second kind, the kind who have graduated from the first category. They don't count the number of deals they've done. What counts to them is the number of people they impact and the depth to which they impact them. Achievement is still important to them, but it's subordinated to the depth of their purpose. So they give freely of their time, knowledge, and expertise to build a bridge for those who follow in their footsteps. These are the people who were called to change the world. These are the people who develop people, places, and ideas. And this is the show where they do it, on the Creative Commercial Real Estate Podcast. I am excited for another day. Today we're going to have Dan Ruehl from SR Realty Trust on here. Dan deals with purchasing stabilized assets and putting them into REITs and things like that. Pretty cool stuff. So I'm excited to bring you this presentation. Thanks for coming on the show, Dan.
Thanks for having me, Mike.
Did I spell or sound out your last name correctly there?
You did, absolutely.
All right.
I'm pretty used to going by whatever because everyone gets it wrong. So
good. Well, we're doing good so far then. So tell me about Schaefer Richardson and specifically your kind of little segment of the company and what you guys do.
Yeah, absolutely. So Schaefer Richardson's been around for about 25 years. Started as a development company, really redeveloping properties throughout Minneapolis here. Kind of really led the charge on the North Loop redevelopment in Minneapolis. And from that, done a lot of multifamily market rate stuff throughout the past few years and continuing to do that along with some affordable housing as well. About 5 years ago now, the principals of Schaefer Richardson, they've seen a need with their investors that they've had. And these investors from 20 years ago were getting older and, wanted to have kind of a more stabilized investment strategy for these people. And that's when they started this REIT, private REIT, with about 7 buildings that they were redeveloping and created a REIT for their investors really to just, realize those kind of consistent dividends and nice returns going forward. So today we're going to talk about and really gear our conversation to people who have sold a piece of property and they have a capital gain. What are their options? So let's run through those. They can do a 1031 exchange directly into another building that their LLC would own. Yep.
They can do exchange into a DST.
They can, yes.
They can do partner with somebody else through a tenants in common arrangement to take direct title.
Absolutely.
That's kind of the workaround because you can't exchange into membership units, or can you? So the fourth one is what I'm really interested in is what you guys do a lot of, and that's where they can basically exchange into an E-REIT for shares of an E-REIT.
So,
or how does that work?
So, I want to kind of preface this with, kind of the even before they've sold their property. I think this is the best way to kind of approach people with what they can do before they even actually sell their relinquished property here. So they have the opportunity to UPREIT a property with the REIT, which is a form of a 1031, kind of a 1031 exchange, but really it's a 721 exchange. So as long as the REIT is set up as a umbrella partnership REIT, which is what UPREIT stands for, they can contribute that property to the REIT in exchange for shares of the REIT, tax deferred, and they're really, they're giving up all their managing of it. They're giving up kind of being full-time commercial real estate people, and now have taken a real estate asset and converted it into a financial asset. Gotcha. There's that people don't really kind of think about from the start. We go and we'll find property, we'll find OMs out there, and we'll really talk with the brokers about who is the seller of this. Could they be a good fit for just a direct UPREIT of their property into the REIT if we like their property.
So an UPREIT is through a 721 exchange where they're actually not selling anything. They're exchanging their ownership in exchange for shares in the REIT.
Correct. It's operating partnership units in the REIT. So, you can invest into a REIT and pay their stock price and get units that way, and then you're a voting, shareholder of the REIT. This, you are not a voting holder of the REIT, but the shares are essentially the exact same as, if you were to just write us a check for $50,000 and get your actual shares for that price. So the shares continue with, the same stock price, same dividend payments. You just don't have a right to vote for the REIT.
Sure. So walk me through one of these transactions. How's it all lay out? What's the timeline and process look like?
Pretty much exactly like a normal transaction. It really, we'll tour the property. We'll, decide purchase price. We'll, lay everything out in the purchase agreement. Timing wise, we'll do our normal due diligence period on it, normal kind of closing period on it. And at that point, it, just a standard kind of closing that you'd normally have with a normal transaction. Really, the commercial brokers still get paid their rates that they're charging, and it's really just it's a fairly simple transaction. We've looked at one property where we're probably gonna have to get a phase 2 and vapor done, and the process can wear on for that because we have to do our proper due diligence because we still have that fiduciary duty to the rest of the REIT members, and also the owner of the property that we're buying that would be UPREITing, they will be our partner as well because it is a partnership in the REIT, and they want to, we want to make sure that they know that they're still going to have some ownership in that building along with the rest of the properties as well. So we need to make sure we're doing our proper due diligence on that. But it's really essentially the same as a normal real estate transaction.
Can they pull money out of the deal as well?
Yes, absolutely. They can take as many shares as they want, take cash if they want. We can be very, very flexible on that.
I know you're not a CPA, but what have you seen in terms of tax liability? Let's say the REIT's paying $3 million for the building. My basis is, let's say, $2 million, and I want to take $500,000 in cash. Is that all taxable, do you know, or is it prorated?
I don't know. I don't have.
Okay.
I'm not qualified, I think, to answer that right now. When we are looking at doing some of these deals, we really look at people who have owned the building for 30, 40 years. They have, essentially they're going to have all capital gains tax on the property.
Yeah.
And that's where we really think this can be a really good fit for those people.
Who unlock the mindset of your typical client? Why is this a good idea for them?
It really, estate planning purposes. I mean, our typical client in this deal is probably going to be thinking about their estate. It's, a guy or gal who's, in their 60s, 70s, 80s, don't have kids in the business, don't want to take over the real estate part of their business, and they want to make their estate as easy as possible. They've now, if they UPREIT their property, they now have shares in a REIT instead of a real estate asset. They can split out those shares any way they want to their heirs, lay it out fairly simple. And when sounds a little bit morbid, but when they do pass away, those shares get stepped up, and their heirs have them at that stepped up basis. So it's really kind of that estate planning purpose is what, our typical client in that situation is.
Sure.
And in all of our deals that we're really doing, and all of our, really all of our deals that we're doing, it's the a little bit older crowd, or the people who just don't want to have the hassles of owning, managing real estate.
Sure. So, devil's advocate,
Mm-hmm.
why would they do this over, let's say, like a DST structure? Well, first of all, let's talk about DSTs.
Yeah. I like DSTs. It's
Okay.
we're trying to find a way to do DSTs.
What's the difference between what you're doing and a DST?
So what we're doing, we've been doing tenant in common deals, so TIC deals. TIC gets a little bit of a bad rap from back in the day when people were loading them up with 15 to 20% on top of the purchase price, and then being underwater right away. So, but we are not doing that. We put about. We take a 2% acquisition fee on our deals, and then a 1% real estate commission that goes to the brokers who are bringing us 1031 people if we're doing a TIC deal. So that's a big difference for us. I mean, DST, we cannot pay a real estate commission. It's a financial transaction, so we are not licensed to do that, and DSTs are typically sold through third parties. We haven't been able to find a way to pay a real estate commission on that, so that's why we haven't done a DST yet, but we really would like to. I think our plan is to do a DST and to be able to sell it in-house through people who we're meeting who have 1031 need.
How is an UPREIT different from a DST?
Yeah, so UPREIT is a straight. An UPREIT is an end game, really. So a 721 exchange, you cannot 1031 out of that again. That is, it's really the end game. You've converted this real estate asset to a financial asset now, and there's no way of getting back into that. Where a DST, if you sell your property and get into a DST, you still have that option. Once the DST runs its life, that you can 1031 into something else, or you have other options after that. It's really about where you're at in your real estate game and what you really want to accomplish with it. If you're really at that point where you're sick of and DSTs, you don't manage them, you don't do that kind of stuff, but you still have that opportunity later on where you can 1031 into something else if you want, where an UPREIT transaction, you do not have that.
Now, with the DST, and correct me if I'm wrong, but it's basically a loophole to be able to exchange direct titleship in a property for membership units in a company that owns it, but you're buying a specific piece of property.
Yes.
And with that, it's not very liquid. It's hard to get out of it.
Exactly.
And so that's one of the big cons with a DST. The
Yep.
pro is obviously that you can continue deferring after that project is stabilized,
Yep.
and they basically give you liquidate your shares. You have to roll that into something else.
And typically, that's where these DST sponsors, they kind of, I'm not going to say they get you, but they kind of,
Once they
have you, you find something else within their group that you can easily roll into, and they make life very simple for you. And it's a very hands-off approach to owning real estate, which, again, I think is a great option for some people. I've just had a buddy of mine who wants to get out of a townhome or a duplex, and trying to find a way to keep his money rolling. And I told him this is a great way. My company personally, we don't have anything ready for him, but finding one of these DSTs is a great option for him.
Sure. So a DST, so they can pick, hey, I want to do it all in this one particular project, or I want to split it up into 10 different projects and stuff like that. With your REIT, they have no control over the projects. They buy the shares, and you guys are able to buy and sell assets, and the portfolio changes over time?
The portfolio can change over time. I mean, we are a long-term holder of real estate, so we don't have plans to really sell a lot of the properties that we're buying in the near future, but we have 10, 20 years down the road, we might be selling properties that will be 1031ing into other properties at that point as well.
Okay.
But the idea is for us to grow our portfolio, really. Right now we're at 160 million roughly in asset value, and we'd like to be around that $500 million mark. So big time growth in the next few years to come is really important to us, and really help diversify even more our portfolio. I think the UPREIT in comparison to the DST is a little bit different. We've been trying to buy deals too more with like I was saying, the tenant in common structure, where we'll purchase these deals with 5 or 6 other tenant in common buyers who are looking to place 1031 money, and the REIT purchases a large portion of all these deals to make sure we're getting that cash flow for the REIT as well. And these 1031 people who are helping, they're realizing that income off these properties. So we're really trying to find some off-market deals that the REIT can invest in and get nice returns. And then what we've had happen is that these people who come into the deals with us, 2 years down the road, they might get sick of, being part of the TIC membership, and they'll ask us to UPREIT their share of their property. So they buy these TIC memberships and they get a deed to the property. They'll ask us to buy, to UPREIT their share of that property into our REIT. So they've gotten shares for their portion of that property in the past. It's another option. It's totally up to them if they would like to do that. We're buying these properties, with these people, with them, knowing that they're owning a piece of property and that they're not part of the REIT. Like I said, we've had a few people in the past that why do they want
to get out? Yeah.
Again, they don't want to manage. They don't want to deal with the real estate anymore, and they like our REIT, and they decided, hey, we have this, we can do the 721 exchange. Again, we get out of a real estate asset and into a financial asset, and just kind of helps simplify their life. And they get a, quarterly dividend and stock appreciation instead of ownership in the property.
Well, hold on now. All right. So I own a property. Okay. Do you guys manage properties for other people or only stuff in your REIT?
Both. We do, man. Yep.
Okay. So let's say I'm getting out of the game because I can't bear the thought of shoveling one more load of snow or dealing with another tenant who doesn't pay the rent. Mm-hmm. Why would I roll into a TIC deal, UPREIT my property, versus just hiring you as a management company and not having all the watered down return?
You still have to be, you're still the last person really deciding on leases. You still have that property, and it's really to simplify your life. Yes, you have someone else managing it, but you still have stuff to do with it.
Sure.
Where
managing the manager?
Yeah, pretty much. I mean, and that can be a pain in the butt itself. So this is really, it's a quarterly dividend. It's mailbox money. It's really just mailbox money. You want to retire, you want to go to the beach, you want to be on your boat, and you can go to the mailbox every quarter and grab your check.
Yeah, that makes sense. And let's say your property management company quits. You're just one call away from being back in the game.
Exactly. And then you got to find someone else, and you got to, there's...
But that's how it is on a TIC too then, right?
It is, yes. I mean, we, with our TIC deals, we do, we manage them. The group agrees that we're managing them, but they still have to sign, leases, and they still have to do that if stuff rolls. But, we're trying to find stuff that's not, it's fairly stable, long-term tenants. We don't have a whole lot of roll. We don't have a lot of tenants in there to really kind of make their lives, difficult. So yes, there's still some of that, but still, I think, some of these people that come into these deals, maybe it's in the back of their mind that, hey, I like still being in the game, but I don't want to be fully in the game. And
so it's kind of that midway point.
Yeah. And, in a lot of these TIC deals too, it's a lot of people that can't find replacement property.
Sure.
And that's the big thing. They've sold their property and they can't find a good property that they like. And, or it's they found a property, they have $2 million that they have to place. They found a property for $1.5 million. Well, they got $500,000 left over. Well, what are you going to do with that $500,000? Are you going to pay taxes on it? Or, can you put $500,000 into a TIC deal? Could you put $300,000 into a DST, $200,000 into a TIC? There's a lot of options with that boot that's left over that we can help out with. So even if it's, $100,000 200 grand is kind of where we really like to, get people involved with the TIC deals, just because there are costs with legal and closing costs and, all that kind of stuff that goes into it. Where, I think much lower, it doesn't make a whole lot of sense, but it's another way to diversify your portfolio is what I really like to tell people. If you, like I say, you have that $1.5 million that you have, as part of your $2 million that you need to place, you have that $1.5 million. Well, now you can diversify, with our deal, with a TIC, or you can diversify even more with a DST as well. So, there's those options out there for people as well.
Sure. We've been talking to Dan Ruehl of SR Realty Trust, and we'll be right back after this sponsor segment. Today's show is brought to you by Court Kamen, my guy over at Old Republic Title. They do commercial title services, everything A to Z, from owners and encumbrances reports to title commitments to closings. I highly recommend their services, and you'd be doing yourself a solid to give Court a call or text at 612-336-7215. That's 612-336-7215. I highly recommend these guys. Welcome back to the show. I'm Mike Sowers, your host of the Creative Commercial Real Estate Podcast, and we're back with Dan Ruehl. Well, we didn't even get to the last three on the list, which are rolling into an opportunity fund or just selling your property on like a contract for deed or a master lease to create residual income with less headache. But we're not going there today. So let's talk about tenants in common. So if you're listening to this and you're like, what in the heck are these guys talking about? There's two ways you can buy and take title to property: tenants in common or joint tenants. Or what is it? I think it's called joint tenancy. Joint tenancy. So the difference is this, okay? If me and Dan buy a property as joint tenants and one of us dies, the other one inherits our shares.
Yep.
If we buy it as tenants in common and one of us dies, those shares get inherited by the closest of kin, by that shareholder. So it's just two different ways to take title.
Yep.
So the 1031 laws basically say that if you own property A in, let's call it XYZ LLC, and you sell that property, you have to take title directly from XYZ LLC in the new property. So you can't actually just roll that in to buy membership units in new, ABC LLC, partner with somebody else, and then buy the new entity in ABC LLC. You have to take direct title. Well, let's say that you only have $200,000 to roll in and you need $500,000 in equity to do your next deal. You can partner with somebody else who sold their property, and you guys buy it using a structure called tenants in common. It's different than a joint venture. It's not a joint venture. You're taking direct title in your proportionate share. So talk to me about when you're structuring these deals, Dan. Does everybody in the tenants in common have to bring the exact same amount of capital? Or how does that work? Can there be disproportionate shares of capital? And what kind of legal costs have you seen for structuring these tenants in common? So let's say we buy a property in LLC, me and you, we don't have tax advantage money, and we just want to do a joint venture. Mm-hmm. Let's say I'm paying $5,000 for to set up my LLC, put together my articles and operating agreement and all that stuff. Mm-hmm. There's a different agreement put together for tenants in common. It's like a tenants in common agreement.
Yep.
Right. So how do those typically work? Get into the weeds a little bit on that, can you?
All right. So capital wise, you don't all have to bring in the same amount of capital. I mean, the tenants in common deals we've been putting together, we have, we'll have one person bring in, 40% of the equity needed. We'll have, someone bring in as little as, 2-3% of the equity that's really needed in these deals. We leverage them based on, who's going to be coming into these deals, because you do have to replace, your debt as well with the 1031 exchange. So we at some points where, one of our last deals we leveraged it at 65%. Because one of the members needed that much leverage on the property. So, we kind of structure some of these around kind of what the needs are of our TIC members coming into these deals, really. So, fee wise, it's been, legal. We had our last deal was a $20 million purchase in Kansas City. We brought in the end, it's going to be here 9 TIC members. Our total legal, we're probably right around that $30,000 mark.
Okay.
Deal before that, the lender required us to set up pass-through entities. So we created essentially what our building name is. Executive Park 1, 2, 3, 4, 5, and 6 for each of our TIC members. And so it required a little bit more work, and it was a $12 million deal roughly, and we ended up with about 20 to 25 grand in legal fees. So, it can vary, but that was, again, our first time doing that. It was, just something that we really hadn't done. We had some leasing issues too that we had to figure out as well with that whole thing before closing. So that's kind of all part of those costs associated with that as well. So it can just really vary deal by deal a bit, but I'd say 0.1% of the overall deal price, maybe something like that, is kind of, I think, a pretty good starting mark on what legal fees could probably be.
Okay.
Yeah.
Cool.
Yeah.
So let's say I put in 40% of the capital. I have to get 40% of the shares, right? They have to get their proportionate share of interest in the
deal.
In the deal.
Yes.
Right?
Yep.
So that's the difference. Like if we're just doing a joint venture, you can bring 100% of the capital, but we can agree to split the shares 50-50.
Yep.
In a tenants in common, if you bring 100% of the capital, I won't get any shares.
Yeah, you're
Right.
getting your amount that you're.
So the shares are distributed based on the capital and the capital alone.
Exactly.
Okay, so that's the biggest difference between that and doing a joint venture. Besides the fact that you can't do a joint venture in exchange.
Yep, exactly. Yeah, and then whatever income the property is receiving, that's your 40% that you have. That's the amount of income you're getting off of that total income out of it. So
gotcha.
Yep.
So for you listeners, if you're wanting to partner with somebody and you're kind of the operating partner, you want to go find the deal, lease it, construction and property management, and you want to find a capital partner, if that capital partner's got 1031 money, that's not a good fit for you because they can't roll that into your joint venture that you're planning on doing.
Yep.
And you can't roll it into a tenants in common or you won't get any interest if you're not putting your money into it. So just keep that in mind. Let's talk a little bit about your role kind of as the analyst and deal finder on these things. What kinds of properties are you looking for, and then how do you underwrite what you're willing to pay?
Our last deals we've been buying are pretty much all industrial deals. Kansas City's been a good market for us. Those have been the last 2 deals that we've closed. We've been really looking industrial kind of throughout the upper Midwest here, Minneapolis, Milwaukee, Des Moines, Kansas City, Omaha. Are kind of and St. Louis are kind of the markets that we've been focused on. But along with that, in general, our REIT is a diversified REIT. We have some retail, we have some multifamily, we have some creative office. We're very close to finalizing a purchase agreement on an office building here coming up, single tenant net leased office building. We're very diversified in that way. But I will say, our probably our main focuses are the industrial. Multifamily is going to be a focus here. I know the cap rates are very low on those, and so it's tough for us to find the right deal. But it is something that we're out there actively searching, and I think that's a good opportunity for us actually for an UPREIT potential coming up. Is finding a partner who really likes our REIT and would like to contribute that multifamily property into our REIT. But then also single tenant net leased office. Those are kind of our three main areas that we're really focused on, I'd say. Underwriting these deals, we're always asking these brokers, kind of what pricing expectations are, and just keeping on their radar is kind of the big thing. Our dividend right now is a 5.6%. And that's an annual dividend paid quarterly. So we can't be below that really. Otherwise we're not covering our dividend, and that's not doing good for our investors. So, we try to if we can get to a 7.5 cap on some of these industrial deals at multifamily, we can do less of a cap just because its capital reserves are above the line, and we can maybe get some better financing options on those as well. We can pay a little bit higher number for that, but again, we're trying to get some of those deals. We haven't been able to land one yet. But yeah, so it's really getting to the number we can pay. We're analyzing deals every day, and if we can't get there, we can't get there. But we put in offers on stuff we like, and just try to get them that way, really. So it's just a daily grind in finding these properties.
Sure.
Yeah.
So you're not asset class specific.
No.
And you guys are only looking for stabilized properties?
Yeah, pretty much. I mean, we can do up to 10% of our asset of our equity value in the REIT into value add properties. So right now that'd be roughly $7 million in value add properties that we could do. We don't want to be at 10%.
Sure.
Mean, right now we do some investment deals into our development projects that Schaefer Richardson's doing. We probably have $1.5 million invested into value add stuff. But typically stuff 75% occupied or better is really kind of where we really are looking. 85% is probably, I'd say, really kind of the stabilized and above that, but yeah, so yeah, we're really stabilized stuff is kind of what we need. I mean, we need that cash flow in order to pay the dividend. If we're not paying the dividend, then we're not doing our job.
Well, that's next level stuff, because basically you guys have an arm that goes out and does value add and opportunistic stuff, and then you guys can operate your stabilized properties into this separate the realty trust. Yep. So really, you guys are kind of syndicating or finding properties that are stabilized on the back end there. Syndicating is probably not the right term, but operating properties that are stabilized.
Yep.
So you'd be a great person for anybody who's doing value add deals to be an exit strategy guy.
Yeah, absolutely.
So when you're evaluating a stabilized property, are you looking at, is your approach potential net operating income, and then you work backwards into what it should be worth, and then you subtract some costs there to get there? Or how do you guys actually analyze? Or are you just looking at current in place net operating income as the sole book of?
It can be a little bit of both. I'd say it's kind of really dependent on the actual real estate there. So we I'd say we typically look at getting the building, if we're at, 90%, we typically underwrite it, getting the building full to, 100%, taking our vacancy factor off of there, and, capital costs and whatnot, and backing into the number that way, is really how we're analyzing these deals. So yeah, it's kind of a bit of a, pro forma, here's the building we think is 100%, maybe it's a 7% vacancy, maybe it's a 10% vacancy on it. But we're definitely taking, doing our due diligence on what the correct vacancy percentage on this is.
How do you figure that out?
Really looking at market data, looking at what's in place now, if we think this is really kind of what it is. I mean, right now, suburban office, if you're looking at suburban office, you're probably looking at a 15 to 20% vacancy, because that's just what vacancy rates are at.
You doing like CoStar reports or what?
Yeah, and, pulling them from CBRE, pulling them from Cushman, we're doing all that in every single market that we're looking in, and really talking with the brokers in the markets that, we don't have those reports in, like, Lincoln, Nebraska might be one where we, Schaefer Richardson as a whole has done a couple development projects in Lincoln, and we have one project in the REIT, and really knowing the brokers there and talking with them about what actual vacancy rates are there is really how we're doing that. So, and really, getting down into the submarket of those as well. It can be really dependent on a lot, here in Minneapolis, and let alone, Kansas City is a whole different ball game with, where, you might be in one of the counties in Kansas and the vacancy is 10%, while, just across the border, it's at 3%. So it's just, it really, there is even more volatile than kind of around here. So
do you guys, how do you apply a vacancy factor to a single tenant deal?
We're usually at about a 5% vacancy deal, and it will
credit loss.
Yeah, and it really depends on the tenant. If you got a nice credit tenant, then maybe it's a little less. If you got someone who you're like, well, I really think these guys will actually probably vacate in 4 years, even though they got 10, 15 years left on their lease, well, then we're probably taking a 10-15% credit on there. But and then again, talking with brokers about what's this market, how long are normal downtimes of these buildings, and what would we need to do if we needed to multi-tenant this building out, what would just kind of really taking into consideration all those factors that that can happen. And sometimes we'll do two models. What if if we got this thing, if this tenant goes out in a year, what's it look like? If this tenant sticks around and renews and, they can pay their rent, then, what's it look like? So just so we know kind of what we're getting into.
You had mentioned before capital reserves above the line for multifamily. Mm-hmm. I understood you based on our last conversation. Can you kind of unravel that for our guests?
Yeah, so typically, with a lot of these kind of net leases, triple net leases out there, when we're looking at industrial deals and office deals, your capital that the owner of the property really needs to pay to keep these buildings up is typically a cost just to the owner, nothing that kind of affects your net operating, or it doesn't affect your net operating income in these deals. So we're looking at, it affects what we're actually making on the property, because we need to incur those costs, but it's not kind of dependent on what we're really paying for the property, which is, taking our cap rate at the net operating income. And with multifamily, your capital is typically above that line, so it really does affect what your final net operating income is on multifamily. So, a lot of these newer projects, you're reserving $200 a unit in or per apartment or whatever in these multifamily deals, and and that you need that cost when tenants leave, and you need to make changes and do some upgrades and whatnot, and that stuff is above that NOI mark, so it affects what your net operating income of that property, and then which in turn affects what you're paying for that property at the cap rate. So again, multifamily is just different in that aspect, and how we analyze those deals. So
let me be sure I understand you. So when we say above the line stands for the line on a P&L right above the NOI there, right? That's the line that basically it's operating income minus operating expenses.
Yes, correct.
What you're saying is multifamily buildings are trading at an NOI that includes a reserve.
Yep.
And industrial and office buildings are trading at an NOI that would not include the reserve. The reserve will affect the true cash flow of all properties. But so that kind of subsidizes the lower cap rates in some way in multifamily, because they're going to have a lower NOI because we're taking out for capital reserves.
Yep, exactly.
Okay.
Yep.
So
and where our old the prior president of UPREIT, actually, he was really trying to push us to look at even industrial deals, with more along the take out our capital reserves on there to really affect the NOI, and where are we really at when it comes to that? Because it is a big thing. A roof on an industrial deal can be $5 a square foot, let's say, at 150 50,000 square feet, that's a big number. And if you got to do that, you're losing a lot of money in that year. And, making sure you have the proper reserves for that is pretty pertinent. So
yeah.
Yep.
Critical to plan for that from a cash flow standpoint.
Yep.
So you're really good. I mean, you look at a lot of these deals. My hat's off to you. Can you shed light a little bit on, the big expenses that you look for? How do you analyze the current condition and then kind of project out what kind of reserves you need for big things like roof, mechanicals, that kind of stuff?
Mm-hmm. Yeah, typically, typically we're asking for a list of their mechanicals with ages and tonnage and, condition, any reports they've had done in the past. Same with roofing. Most of these packages list how old the roof is. I think useful life on any roof really is about 20 years unless you really have a built-up roof that's, maybe 30 years on it. If you had a steel roof, maybe it's a little bit more. But, typically we're at 20 years. So we like to see a building with 10 years left in a roof at least before we really start kind of deducting for a roof need. And at that point, it's kind of, over 10 years, if we're at year 9, well, we got 9 good years left. So kind of the prior owner pays for a year's worth of a roof kind of is how we're really looking at it. So, and then, once we have these under contract, well, then we're doing our PCA, we're doing our phase 1 stuff, our property diligence on them. We'll get an actual, roofer we trust out there to look at these roofs and to give us, useful life remaining in their eyes and repair needs and replacement costs and doing it that way. Me being, my prior life, I was a property manager and worked with roofers all the time on these reports and kind of knowing a little bit more of what to understand when looking at those reports and looking at roofs in general. And so I feel like I can have a good idea of, getting up there and kind of seeing what might, need to be done here in the near term at least. So, and then we just take our factor. I think talking with some roofers, I think a good number is right around that $5 a square foot is kind of a good number to keep in there for a roof replacement.
Man,
really.
I got to get your roofer's phone number.
You got to get a roofer in St. Louis that I just talked to quoted me $2 a foot. And we were shocked about that, so.
Yeah, those are the ones you don't take.
Yeah. Yes. And $5 to $7, I think is, fairly, I think, 5, I think you can get it done at that. 7, 5 to 7 is kind of right in that ballpark, I think. So, that's kind of the reserve we're taking. Like I said, if, there's 5 years left on of useful life of the roof, we'll take that into consideration too, and deduct half of a roof then at that point. So
that makes sense.
That's where we're looking at our numbers and coming in on these deals at.
So let's say, all right, so we got a fully adhered rubber roof, 20-year lifespan. They told you they replaced it 15 years ago. So walk me through the math on this. You got 5 years left. Mm-hmm. We got a 100,000 square foot building.
Yep.
So you're figuring 500 to 700,000 to replace.
Yep.
So you're gonna ding the purchase price $250.
Yeah.
And then you're going to budget $50,000 a year, $50 to $70,000 a year as a capital reserve.
And you'll have other capital needs too. So we typically, we're taking just a number per square foot per year, and then if we need a roof reserve too, then we'll take that as well, kind of throughout those those next 3 to 5 years. We'll take that as well. I mean, we this last deal we did in Kansas City, we know we're going to have to do a roof on a 500,000 square foot roof building in within 5 to 7 years probably. So these first 5 years of ownership, we're taking out $300,000-$400,000 a year in a reserve for a roof replacement. So it all factors into what we can pay, and I'd say most people looking at these deals and and even the sellers understand what's going to need to be done, even though they don't want to hear it.
Yeah, I hear you. So where do you guys put your reserves?
Typically with the bank that
Okay, so they just sit in
they sit in a bank account.
A massive interest-bearing checking account.
Oh yeah, huge.
Yeah, dude, quarter of a quarter of a quarter.
Oh yeah.
Of a point. Yeah, just killing it on that. I didn't know if you guys had a good strategy for that. I was thinking about that as we take on more properties in our management portfolio. What can you do with reserve money that's not risky?
Yeah, our last lender, they required us to have a reserve account with them. So,
okay.
they're hanging. We got we got our account with them and just funding it every month and rolling with it there. So,
yeah, that's good. So we got roof, we got the mechanicals. So you got the kind of 20-year rule of thumb with the 10-year prorated deal. How do you look at mechanicals?
It kind of varies too, depending on who's really maintaining them per the leases. So we'll look at the leases. If the tenant if they're the ones in charge of repair replacement, we don't, it's still a factor because if they leave, you're probably still going to have to do it. But typically, if they're in charge of it, then it's understanding the age and really talking with the tenants on when repairs and replacements are needed on these things. So, I'd say, HVAC units are probably a 15-year useful life, 10 to 15-year useful life on those. And parking lots are another big one for us. The asphalt is a big number. So that, again, probably 15, 20-year useful life on parking lots are typical before you have to do a, overhaul, mill and overlay or something like that on them. So, again, rough numbers on those. Try to get kind of some bids before we go in on some of these parking lots because they can really vary. Or before we go in on any of these properties, we'll try to kind of get a number from a vendor.
What have you seen as a range?
I mean, it's
crazy.
It is crazy. I mean, I think it just depends on how busy these guys are. It really is what we'll see.
Supply and demand of the week.
Come back. Yeah, exactly. I mean, luckily since I've been buying properties, we really haven't had have to do many of those yet and get bids on those. But when I was managing property, I mean, we were looking at a mill and overlay on one property that was, I think it, whole parking lot ended up being about $600,000, and I don't even know what that equates per square foot, but it was a pretty high number. So wish I had better knowledge or better memory on that for
Gotcha.
you, but
no worries, we can move on. So we got parking lot, roofing, mechanicals.
Yep.
Any other big ticket items?
If you get into office, you got elevators.
What do you figure on those?
I don't, that's one reason why we try not to deal with office too much, because it's a capital expense that we just don't want to deal with.
Yeah.
So I replacing those are crazy expensive. I mean, $100,000-$200,000 an elevator if you really need to, modernize and update those.
Well, and you're building in the annual maintenance checks and stuff like that in your operating income.
Yeah, and like I said, we haven't analyzed and bought, office that needs that. So
Sure.
we try to stay away from that really, just because it's one of those capital items that, you get into office buildings, you get way more capital items than you really need.
So you said you kind of do just kind of a catch-all budget for reserves on some of these. What are you looking at per asset class? Does it vary by asset class?
Yeah, it varies by asset class. I mean, it varies. I'd say it's kind of more how old your building.
Okay.
We own a building in Northeast Minneapolis that's an older building that we're budgeting 60 cents a square foot per year for just a capital reserve account, amount. So, tuck pointing, some window replacement, and, includes some parking lot work if needed, some HVAC work if needed. But, if you got a 5-year-old building, well, chances of having large capital items coming up soon are fairly low. So you're probably looking at 10 cents. I've seen some OM packets that come out that are, they budget 5 cents a foot, but which is, I think, fairly unrealistic because you're going to have a lot more capital needs than that coming up. And I think it's better to, I'm probably more conservative with doing some of these analysis, and, try to probably do a little bit more, in that 15 to 20 cent a square foot kind of range for a lot of these industrial deals. And again, really depending on how old the building is.
Yeah. No, that's great. So we'll kind of wrap up. Let's summarize. So we had talked about just kind of different strategies for people who are selling a property and have a capital gain. You can roll into direct ownership in another property by yourself. You can basically partner with somebody and you both take direct title using a tenants in common, often referred to as a TIC structure. You can just UPREIT your property into something like the SR Realty Trust and be completely hands-off mailbox money. DST is kind of a trade into specific properties and is maybe not a forever solution because you have to keep going and exchanging out of those, but offers some other unique advantages. And then we didn't get into like opportunity funds, trading equity, contracts for deed master leases, but those are kind of other episodes. Any final tips that you would have for somebody who has a taxable gain?
When you're looking at these deals, I would really say, try to get into the weeds with, these groups who, if you're looking at DST, look at what they are loading these deals with. That's a big factor. And I said this earlier is that, that's where the tenant in common structure had gotten a bad name in the past is, they were loading these deals with 15 to 20% on top of the purchase price and getting underwater, right away. And so, I would just be cautious about what these sponsors are doing. They'll typically take a fee with the acquisition. They'll take, fees when they sell. They'll take fees when, they'll kind of take fees whenever they really can. So try to get into the weeds when you're looking at these deals.
Yeah. I've actually done that and looked at a couple of the local companies. I'm not going to name them, but the layers of fees were crazy to me.
Yes.
So they sell you this big rosy picture that it's this hands-off, retire. Well, you're taking all the risk still.
Yep.
And they're taking all the profit.
Yep.
And yeah, you have a risk-free return, but oftentimes in some cases, maybe selling your property on a contract for deed or finding a superstar property manager where you're literally making double the returns because you don't have all the watered-down returns.
Yep.
And you're taking the same exact amount of risk ultimately as if you DST'd into that specific property who's still being managed by that same company. They just have all these other fund layers. Like, I know some of them are paying like upwards of like 5% just to the financial advisor who puts them into these funds on the front end. Yep. I'm like, man, that's 5% acquisition fee right off the top.
Right off the top. Yep. And they'll take a 2 to 3% actual acquisition fee on the property. Sure.
And then the annual money management fees and all that adds up.
Yep.
You take a property that's truly producing 18% IRR and it gets watered down to 6% somehow.
Pretty quickly. Yep.
Well, I really appreciate having you on the show, Dan. You've been a blessing so far in our relationship, and I wish you the best of luck. And I got one personal question for you.
Yeah.
And that would be, how do you start your day?
Let's see. I typically start my day by getting my son kind of up and ready. He's usually the one waking us up in the morning, so go in there, give him a big hug, and get him out of his crib and get him ready for the day. And from there, it's kind of, it's a good day after that. So.
Well, you got a smile ear to ear just talking about it.
Yep.
All right, one more for you.
Yeah.
If you had one day left to live on planet Earth, how would you spend it?
Oh, geez. I think probably just with my family. You just gotta be around family. I think those are the important people to you in the end. And just hanging out with my dad, hanging out with my son, hanging out with my wife. Maybe playing around to golf with them would be fun too. So
awesome.
Like that. Yeah.
Well, hey, if people want to find you and reach out, how do they contact you?
They can give me a call at 612-359-5857. That is my work number. Otherwise, my email address is druehl@sr-re.com. Or on our website at srrealtytrust.com.
Great. Well, this is Mike Sauer signing off.
All right. Thanks, Mike.
Thank you for listening to our show, Creative Commercial. Head over to our website at creative.realestate or find us wherever you listen to podcasts. And please, if you like the show, leave us a review. It really helps us out.